Today we're going to look at the company Spok Holdings, headquartered in the United States and traded on the Nasdaq under the ticker SPOK. Please stay tuned for the important disclosure information at the conclusion of this video. Spok Holdings traces its roots back to the early 1980s, beginning with the incorporation of Advanced Communications, Inc. in 1982. The company truly began its journey toward becoming a national leader in wireless messaging when it went public in July 1993 under the name Metrocall, operating primarily along the East Coast of the United States. A transformative milestone occurred on November 17, 2004, when industry giants Arch Wireless and Metrocall merged to form USA Mobility, creating the largest paging network in the United States. This new entity began trading on the Nasdaq under the ticker USMO. Recognizing the eventual decline of traditional paging, the company shifted its focus toward software. This pivot accelerated in 2011 with the acquisition of Amcom Software, which provided critical tools for clinical alerting and emergency management. To reflect this evolution from a hardware-focused paging carrier to a unified software and communications leader, the company officially rebranded as Spok Holdings on July 8, 2014. The name Spok was chosen to evoke the spokes of a wheel, symbolizing the company's role in supporting an integrated network of healthcare communications. Today, Spok is a global provider of critical communication solutions, serving over 2,200 hospitals and maintaining its position as a vital link in healthcare infrastructure. Spok Holdings operates a dual-stream business model that bridges legacy telecommunications with modern, mission-critical healthcare IT. The company is organized into two primary business divisions: wireless and software. The wireless segment continues to provide traditional paging services, which remain a staple in environments where cellular signals are unreliable or where high-resiliency communication is non-negotiable. Meanwhile, the software division, centered on the Spok Care Connect platform, focuses on high-growth areas like clinical alerting, secure messaging, and contact center automation. The primary customer base is heavily concentrated in the healthcare sector, where Spok serves more than 2,200 hospitals, including nearly all of the top-rated medical centers in the United States. Beyond healthcare, the company serves the U.S. federal government, military branches, and large enterprises that require robust emergency management and notification systems. While the vast majority of its revenue is generated within the United States, Spok maintains a strategic international presence with operations and customers across Europe, Canada, Australia, Asia, and the Middle East. This global footprint allows the company to export its specialized clinical communication workflows to diverse regulatory environments. By leveraging a high percentage of recurring revenue, approximately 80%, Spok maintains a stable financial foundation while it continues to transition its legacy pager users toward integrated software solutions. The financial journey of Spok Holdings over the past 2 decades is a textbook study of a company managing a secular decline in its core legacy product while aggressively pivoting to a high-growth alternative. In the mid-2000s, operating as USA Mobility, the company was the dominant force in the paging industry. However, as cellular technology advanced, the demand for traditional paging services began a steady, predictable decline that is still visible in the annual revenue drop from nearly $500 million in 2006 to approximately $73 million today. To counter this, the company executed a transformative acquisition of Amcom Software in 2011, which marked the birth of its software segment and the eventual rebranding to Spok. This software division provides enterprise-grade communication solutions specifically designed for the high-stakes environment of healthcare. These tools manage everything from hospital call centers and clinical alerting to secure messaging, ensuring that clinicians can reach one another instantly during emergencies. Unlike the wireless segment, which continues to see a gradual reduction in units in service, the software segment has become the company's primary growth engine. In recent years, software revenue has stabilized and begun to expand, driven by a strategic focus on multi-year maintenance contracts and professional services. This shift is crucial because it moves the company toward a more predictable, recurring revenue model that offsets the churn seen in the pager market. The year 2023 was particularly significant for Spok, as it recorded its first annual total revenue growth in company history, signaling that the software gains were finally beginning to outweigh the wireless losses. This momentum has carried into 2024 and 2025, where the company has reported record-high software bookings and a substantial backlog of work. Management has also focused on increasing the average revenue per unit, ARPU, for its remaining wireless customers by providing specialized hardware like the Gina pager, which offers encrypted, HIPAA-compliant messaging that standard smartphones cannot always guarantee in the shielded environments of large hospitals. Today, Spok operates with a lean, debt-free balance sheet, prioritizing the return of capital to shareholders through a high-yield dividend, while reinvesting in research and development to modernize its Spok Care Connect suite. While the total revenue remains lower than the paging peak of 2006, the quality of that revenue is arguably higher now, consisting of mission-critical software integrated into the workflows of the world's leading healthcare institutions. The financial history of Spok Holdings over the past 2 decades serves as a masterclass in managing a melting ice cube, a legacy business in secular decline, while pivoting toward a high-value software future. This journey begins in 2006, when the company, then known as USA Mobility, was a dominant force in the paging industry. At that time, total revenue approached $500 million, driven by millions of active pager units across the United States. However, the rise of cellular technology meant that every year, a portion of that revenue base would naturally erode. The management team's primary challenge was to capture as much cash as possible from this declining wireless stream to fund a transition into software while simultaneously returning massive amounts of capital to shareholders. In the early years of this table, from 2006 to 2010, you can see the high-efficiency nature of the legacy paging business. Cost of goods sold, COGS, and general and administrative, G&A. Expenses were significant but manageable, allowing the company to generate over $100 million in annual operating cash flow. Because the infrastructure for paging was already built out, capital expenditures, CAPEX, were remarkably low, often staying below $7 million. This dynamic created a cash cow that allowed the company to pay out substantial dividends and buy back stock, a trend that defined the first decade of this reconstruction. During this period, there was no formal research and development, R&D, expense column because the technology was mature and static. The pivot point occurred in 2011 with the acquisition of Amcom Software. This strategic move introduced the R&D and software revenue streams seen in the later years. As the table shows, starting in 2012, R&D becomes a permanent fixture of the expense profile, reaching double digits as Spok began building its modern clinical communication platform, Spok Care Connect. This shift also changed the expense structure. While wireless COGS began to shrink alongside the revenue, sales and marketing, S&M, and G&A had to stay robust to support an enterprise software sales cycle, which is far more complex than maintaining legacy pager contracts. The period between 2017 and 2021 was a difficult transition era. Total revenue continued to slide as the wireless decline outpaced the software growth, and operating cash flows compressed into the $10 million to $15 million range. The company was heavily investing in its next-generation Spok Go platform, which drove R&D costs to their highest levels. However, by 2022, management made a pivotal decision to sunset the Spok Go initiative and return to a cash flow-first strategy. This included a major restructuring that slashed G&A and redirected focus back to the highly profitable legacy paging business and the established Spok Care Connect software suite. The results of this 2022 pivot are strikingly visible in the 2023 and 2024 data. Despite total revenue stabilizing around $138 million, significantly lower than the 2006 peak, operating cash flow surged back toward $30 million. This was achieved through ruthless expense discipline and a focus on high-margin software maintenance. For the first time in the company's history, 2023 saw year-over-year revenue growth in both the software and wireless segments, proving that the ice cube had finally begun to stop melting faster than the software could grow. A critical metric in the final columns of the table is free cash flow, FCF, minus stock-based compensation, SBC. This true cash flow represents what is actually available to owners after accounting for the dilutive effect of paying employees in shares. For Spok, this number has remained positive in almost every year of its existence, which is a rare feat for a technology company. It underscores the company's commitment to being a total return story, where dividends and capital preservation are prioritized over speculative growth. As we look at the projections for 2025, Spok is entering a new phase of maturity. Revenue guidance has been raised throughout the year as software bookings hit record highs, and the wireless segment shows surprising resilience through price increases on mission-critical medical paging. The other column in the table remains close to zero, reflecting a transparent bridge from revenue to cash. Spok today stands as a debt-free entity that has returned over $700 million to stockholders since 2004, a figure that actually exceeds its current market capitalization. This financial narrative concludes not with a decline, but with a stabilization that ensures Spok remains the indispensable communication backbone for over 2,200 hospitals nationwide. The story of Spok Holdings over the past 20 years is defined by a management philosophy that treats every dollar of cash as the property of the shareholders. While most technology companies prioritize hoarding cash for moonshot projects or empire-building acquisitions, Spok has spent 2 decades doing the opposite. As the table demonstrates, the company has returned a cumulative $1.54 billion to its owners through dividends and stock repurchases since 2006. This is a staggering achievement when one considers that the company's current market capitalization is often less than 1/3 of that total return. This was made possible by the unique Note 6 financing status, a commitment to carrying zero interest-bearing debt. By avoiding the burden of interest payments, Spok has been able to navigate the secular decline of the paging industry with a level of agility that its leveraged competitors never possessed. The early years of this reconstruction, from 2006 to 2012, show the company in a state of intentional right-sizing. Following the 2004 merger that created USA Mobility, the firm sat on a massive cash pile of nearly $600 million. Recognizing that the paging business was a cash cow that did not require heavy reinvestment, the board chose to liquidate this excess cash. This explains why the total capital returned in those years far exceeded the free cash flow. The company was essentially paying out its old savings account and the proceeds from selling off legacy real estate and tower sites. This strategy of returning old cash allowed the company to stay lean and efficient while still rewarding long-term investors with some of the highest yields in the telecommunications sector at the time. The pivot in 2011 to acquire Amcom Software was the single largest deployment of capital for growth in the company's history. Even during this $163 million acquisition, the company remained debt-free, using its internal reserves to fund the transition into healthcare software. This era began a shift in the capital allocation table where research and development, R&D, became a permanent expense, and the FCF, SBC metric became more volatile as the company invested in new platforms like Spok Go. Despite this volatility, the company never abandoned its dividend, even during the leanest years of 2017 through 2021. This commitment created a base of loyal, yield-oriented investors who understood that the company was using its debt-free balance sheet as a strategic buffer to survive the high-cost transition to a software-first model. The modern era, represented by the 2022 pivot and the projections for 2025, shows a company that has successfully crossed the chasm. By sunsetting high-burn projects and refocusing on its core hospital communication suites, Spok has restored its free cash flow to levels that once again support a massive $1.25 per share annual dividend. While the current payout remains slightly higher than the annual free cash flow, the company is comfortably using its remaining cash reserves, rebuilt through disciplined management, to bridge the gap. With over $1 billion in total dividends paid out over the last 20 years and zero debt on the books, Spok stands as a rare example of a business that survived a technological obsolescence by putting its shareholders first and its balance sheet second. Spok Holdings is led by Vincent Kelly, who serves as the company's president, chief executive officer, and director. Currently 65 years old, Kelly has been a foundational figure at the organization since its inception, having officially joined the company in November 2004 when it was formed through the merger of Metrocall Incorporated and Arch Wireless. Regarding his financial compensation, Kelly received a base salary of $500,000. His total annual compensation reached approximately $2.2 million. The ownership structure of Spok Holdings is characterized by a high degree of institutional involvement and public float. Institutional investors hold a dominant position, accounting for approximately 62% of the company's shares. Individual insiders own roughly 3% of the stock, while the remaining balance, roughly 35%, is held by the general public and retail investors. Unfortunately, the liquidation value of the company is negative. Let's build a scenario-based dividend discount model. In this bull case scenario, Spok successfully transitions from a paging company to an indispensable healthcare platform leader. The primary catalyst is the deep integration of Spok Care Connect with electronic health records, making it the operating system for hospital clinical workflows. Double-digit software bookings growth becomes the new norm, eventually dwarfing wireless declines. The company leverages its $0 debt status to make targeted tuck-in acquisitions that add AI capabilities, driving high-margin managed services. The base case assumes Spok continues its current strategy of harvesting the wireless business while growing software at a steady, moderate pace. Catalysts include disciplined pricing that boosts average revenue per unit and the success of the Gina pager in slowing subscriber attrition. In this scenario, Spok remains a cash cow for income investors, maintaining its high dividend yield while growing software just enough to keep total revenue relatively flat or slightly positive. The bear case reflects a scenario where wireless attrition accelerates faster than software can compensate. The primary catalyst is increased competition from larger tech firms and modern smartphone-based clinical messaging apps that render traditional paging obsolete. As the high-margin wireless cash flow shrinks, the company struggles to maintain its massive dividend payout, which currently exceeds its earnings, eventually leading to a strategic dividend cut and reduced R&D investment. In the bull case scenario, we assume the following: revenue growth at 5.5%, operating cash flow margin at 25%, capex growth at 4%, stock-based comp growth at 5%, dividends growth at 5%, stock repurchase at 6%, acquisition spending in the next 20 years at $75 million. Stock repurchases assumes price-to-sales ratio of 2. With this discounted at 7.5%, dividend model yields $21 worth of value per share in 20 years, $29 in 30 years, and $36 in 40 years. In the base case scenario, we assume the following: revenue growth at 2%, operating cash flow margin at 18%, capex growth at 2%, stock-based comp growth at 3%, dividends growth at 2%, stock repurchase growth at 1%, acquisition spending in the next 20 years at $15 million. Stock repurchases assumes price-to-sales ratio of 2. With this discounted at 7.5%, dividend model yields $8 worth of value per share in 20 years, $10 in 30 years, and $11 in 40 years. In the bear case scenario, we assume the following: revenue growth at 0%, operating cash flow margin at 12%, capex growth at 0%, stock-based comp growth at 1%, dividends decline at 5% after a substantial cut, stock repurchase growth at 0%, no acquisition spending in the next 20 years, stock repurchases assumes price-to-sales ratio of 2. With this discounted at 7.5%, dividend model yields $5 worth of value per share in 20 years, $5 in 30 years, and $5 in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.